We have Don in Ottawa on the line. What's your question, Don?
Oh, yeah. Thanks, Greg. David, I've been looking at Walgreens and CVS in the drug market. And I'm sort of leaning now to CVS with their acquisition or the integration of Aetna into their operation. Can I have your opinion on that? And Greg, if I could have the consensus on that. Thanks very much.
Sure thing, Don. Thanks for the call.
Thanks,
CVS.
Don. Okay, so start with the group, the drug stocks, pretty defensive group, but within retail. And retail, of course, had a pretty good 3-4 months. Consumer discretionary is a space that's doing well. I'm not sure that I would call CVS consumer discretionary. It's a little bit more staples. But it had great earnings growth this year, up 19%. Estimate for next year earnings growth is 4%. And I don't think that's enough to be in a bull market trying to take advantage of economic strength. So stocks rallied from 60 at 78. It's had a great lift. It's trading way above the moving averages. I have seen many of the defensive sectors come under pressure over the last week, and I think it's possible that you could see some money rotate away from this. So I would look at something a little bit more economically sensitive than one of the drug stocks.
All right, Don, as far as the street's concerned, they have 19 buys, 6 holds, and 0 sells on CVS. We have Frank in Woodbridge on the line. What's your question, Frank?
Hi, good evening, Greg and David. David, I'm pretty well diversified in the U.S. market. I'm happy with what I hold, except for one sector, and that is the defense and aerospace industry. I've been looking at Lockheed Martin, and another company that kind of caught my eye is FLIR Systems. Mm-hmm. And I've been trying, and it looks like Lockheed Martin is a lot cheaper than FLIR, but I'm not sure in terms of growth rate. Maybe FLIR gives a better growth rate. Can I just get your opinion, or if you had any other pick in this sector?
Sure. Frank, I think you're looking in the right bucket. The aerospace and defense sector is really attractive for a couple of reasons. One, because they have a very long fuse as far as their contracts go. I've said before on air here, the thing that people don't remember is that these are companies that are very secretive, but they're skunk works. Like, they're developing stuff all the time, and it's the one sector that never tells you that we got something great coming down the pipe. It just arrives. So that's another great thing. You don't pay for the future. Lockheed is a very interesting company, and it's a company we've owned along the way. We've also owned FLIR. If I had to pick one right now, I'd probably focus on Boeing. Boeing gives you both the defense side and it gives you the civil aviation side. Civil aviation is very, very strong right now. Stock technically is a little bit better. So I'd look at the Boeing. FLIR is going to be a little bit more aggressive, less around aerospace. But I think given a choice between Boeing and Lockheed right now, I'd go with the Boeing.
Very interesting. All right, we have Adam in Kingston. What's your question, Adam?
Hi, thank you for taking my call. My question is U.S. banks, particularly Bank of America. It has not done much over the last year, which is a bit concerning. I know that you're pro-U.S. banks. I'm just wondering if this one has the most torque to the upside. And also, I'm a bit worried with overstretched valuations. And although you're pro investing in U.S. equities, do you have a price target for the S&P 500? Because you could say U.S. banks are a buy, but do you have a target for the S&P 500? Because if you do, maybe it might not be a time to get into the U.S. banks. Thank you.
Okay. So let's start with the U.S. market. We are trading roughly at the same price we were trading at in January. However, earnings are 20% higher than where they were in January. And in the most recent quarter, 80% of companies beat the estimate. So we're talking about a PE based on an estimate, yet 80% of companies are beating the estimate. And not only that, but estimates have been moving higher in the back half of this year, which is very unusual because usually estimates start out aggressive and are toned down through the course of the year. So the U.S. stock market is not expensive, especially with where interest rates are today. So I think that there is still significant upside in the U.S. market. Now, if we think there's a strong economy and we see that bond yields are rising, that tells us that we think that the U.S. economy is growing and that there is a little bit of inflation in the system. It's very early days. Those are great conditions for something like Bank of America because they make great profit on their net interest margin. Now, on the valuation of Bank of America, it's about 1 times book value. Bank of America has traded at 3 to 4 times book value in bull markets in the past. So this is not expensive. The reason the banks underperformed for a few months is they had a great run from September until February, and then they consolidated. You know, we get used to looking at tech stocks that tick up a little bit every day, but that's not really the way the stock market works. Generally, you get sectors have a rally, they consolidate for a while, they pull back in price or go sideways, and then they have the next lift. So if you look at the comparison between the U.S. bond yield and the banks, the bond yields backed off a bit, the banks backed off a bit, the bond yields have turned up, and the banks have turned up. This is time for the next leg. So I think it's an excellent entry point. And if I had to pick another name besides JP Morgan, I'd pick Bank of America.
All right. Hope we're not giving anything away for the end of the show. Let's take a quick break. Then we're going to be back with David Burrows, President and Chief Investment Strategist of Barometer Capital Management. He wants to answer your questions about North American large caps. So give us a call, toll free, 1-855-326-6266.